Hello and welcome to the Commodities Institute podcast. I'm Emily Costa and today is December 15th, 2025. Thanks for spending part of your day with me as we slow things down and unpack what is shaping commodity markets right now, not just on trading screens, but in politics, infrastructure, and everyday economic life. One of the things I always remind listeners is that commodities rarely move in isolation. Oil prices don't just respond to supply and demand charts. Steel production isn't just about blast furnaces. Agriculture isn't just about weather. All of it sits inside a web of regulation, geopolitics, and long-term investment decisions. And this week's developments make that clearer than ever. Let me start in energy, but not where you might expect. Venezuela has once again become a focal point as the United States tightens its grip on the country's oil exports. We've seen mid-ocean tanker seizures, stepped-up sanctions on shipping companies, and an intensified effort to crack down on what's often called the dark fleet, those uninsured and loosely regulated vessels that move sanctioned crude around the world. At first glance, this sounds dramatic, and it is dramatic for Venezuela itself. Oil exports surged earlier this year as the state oil company rushed barrels out the door ahead of restrictions. Now exports are sliding sharply and production has already fallen meaningfully. Venezuela's oil is mostly heavy crude, thick and tar-like, which means it depends on imported naphtha just to flow through pipelines. As those imports dry up, production risks mounting further. But here's the crucial point for global markets. Even if Venezuela loses several 100,000 barrels per day, the world is swimming in oil right now. Canada, the Gulf of Mexico, and other heavy crude producers can offset those losses. This is not a supply shock story for Brent or WTI. It's a political chokehold story aimed at cutting off revenue to Caracas, not destabilizing global balances. And that distinction matters because in commodity markets, perception often drives price more than reality. Traders hear sanctions and seizures and brace for disruption. But when you step back, the global oil system today has far more slack than it did a decade ago. Now let's move from Venezuela to Nigeria, where another oil story is unfolding. But this one is about refining, not exports. Aliko Dangote, Africa's richest man, is openly clashing with regulators over fuel imports. His massive refinery was built to end Nigeria's reliance on imported gasoline and diesel, a reliance that has drained foreign currency and left the country exposed to price shocks. Dangote argues that continued imports undermine domestic investment, export jobs overseas, and weaken energy security. Regulators counter that local production still cannot meet demand. What's really at stake here is control of Nigeria's downstream market. Refining is where value is captured, and whoever controls that flow controls pricing power, employment, and political leverage. This fight tells us something broader about energy transitions in emerging markets. Building infrastructure is only half the battle. Regulatory alignment, transparency, and trust are just as important. Without them, even a 650,000 barrel per day refinery can find itself fighting for oxygen. Let's pivot now to metals, where China's steel sector continues to send sobering signals. November crude steel output fell to a nearly 2-year low, marking 6 straight months of decline. Margins are thin, domestic demand is weak, and the property sector, once the backbone of steel consumption, remains deeply depressed. What's especially notable is that manufacturing has become China's largest steel consumer, replacing real estate. That shift tells us this slowdown isn't cyclical in the old sense, it's structural. China is producing less steel because it needs less steel, and that has ripple effects across iron ore markets, coking coal flows, and even freight rates. For producers elsewhere, especially in Asia, this raises hard questions. Do you cut output and protect margins, or keep producing and chase export markets that are already crowded? These are not easy decisions, and they will define metals pricing well into next year. Staying with metals but changing geography, South Korea's Korea Zinc is weighing a joint venture with the United States government to build a massive critical minerals smelter on American soil. Zinc, antimony, germanium, these are not household names, but they sit at the heart of semiconductors, defense systems, and clean energy technologies. This move is about supply chain security. Washington wants less dependence on China for critical minerals, and companies like Korea Zinc see opportunity in that political priority. But the plan is controversial at home, with shareholders questioning whether management is using geopolitics to entrench control. This is the new metals landscape: strategic, politicized, and increasingly tied to national security rather than pure economics. Let's turn briefly to agriculture, where France is racing to vaccinate nearly 1 million cattle against lumpy skin disease. This virus doesn't threaten humans, but it devastates herds, cuts milk production, and triggers export bans. Farmers are protesting mass culls, arguing that healthy animals are being sacrificed unnecessarily. Here's why this matters beyond France. Livestock disease outbreaks can quickly tighten global protein markets, especially in Europe. They affect feed demand, meat prices, and trade flows. And they remind us that biosecurity is just as critical to agricultural supply as rainfall and fertilizer. In the United States, soy processing offers a different agricultural signal. Crushing volumes remain historically high, driven by demand for vegetable oils used in biofuels. Stocks of soy oil are building, suggesting supply is running ahead of immediate consumption. But the long-term trend is clear. Energy policy is reshaping crop markets in ways that would have been unthinkable 20 years ago. Finally, let me end in dry freight with a story that deserves more attention than it gets. US freight railroads now emit more nitrogen oxide than all coal-fired power plants combined. That's a staggering statistic, especially for an industry that markets itself as the greenest way to move goods over land. The problem is aging locomotives. Many are decades old and operate under outdated emissions standards. Rail companies have slowed investment in new engines, partly out of fear that future regulations could make them obsolete before they pay off. The result is a fleet that moves freight efficiently but pollutes heavily. This has real costs, measured in healthcare expenses and premature deaths. It also highlights a recurring theme across commodities. Infrastructure lasts a long time. Decisions made decades ago continue to shape emissions, efficiency, and economics today. So when you connect all these dots, oil sanctions, refinery disputes, steel slowdowns, livestock disease, critical minerals, and freight pollution, a pattern emerges. Commodity markets are increasingly shaped by political choices and regulatory risk. Supply and demand still matter, but they're filtered through policy, security concerns, and public pressure. That's what makes this moment so complex and, frankly, so fascinating. I'll leave you with that thought as we wrap up today's episode. If you found this episode valuable, be sure to subscribe, share, and leave a review.